And welcome to the Lumax Auto Technologies Limited Q1 FY2024 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Jain, Managing Director for Lumax Auto Technologies Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. A very warm welcome to our Q1 FY2024 earnings conference call. Along with me on this call, I have Mr. Sanjay Mehta, Director and Group CFO, Mr. Vikas Marwa, CEO, Mr. Naval Khanna, Corporate Head Taxation, Mr. Ashish Dubey, CFO, Ms. Priyanka Sharma, Head Corporate Communications, along with Mr. Ankit Thakral from Corporate Finance, and SGA, our Investor Relations Advisor. The results and presentations have been uploaded on the stock exchange and the company's website. I do hope everybody has had a chance to go through the same. I'll begin with some insights on the economy and industry, followed by the operational and financial performance for the first quarter of FY2024 before opening the floor for questions. Owing to the global economic challenges on account of high inflation, interest rate tightening, and geopolitical tensions, the world GDP rate has been revised down to approximately 3% for both 2023 and 2024. Although the IMF has projected a slowdown in global inflation, anticipating a decrease from 7% in the calendar year 23 to 4.9% in the calendar year 24, driven by reduced commodity and energy prices. On the contrary, India has displayed remarkable resilience in the face of the global economic slowdown. Projections for the year 23-24 indicate a robust growth rate of 6 to 6.5% of GDP, positioning India at the forefront among the world's major economies. This impressive growth trajectory can be attributed to a combination of factors, prominently including a surge in private consumption, investment, and the dynamic expansion of both the service and manufacturing sectors. Moving on to the automotive sector, auto industry holds a pivotal position in India's economy, interlinked with numerous industries, thus playing a significant role in driving economic progress. It is noteworthy that India's automotive market has risen to global prominence as the third largest, surpassing Japan in 2022. Furthermore, India has gained substantial recognition in the international heavy vehicles domain, emerging as the leading manufacturer of tractors, the second largest producer of buses, and the third largest producer of heavy trucks. The expansion of this industry is underpinned by a variety of factors, including the rise in disposable income, the availability of credit and financing options, and the massive surge on infrastructure spending. Commodity prices have reached a state of equilibrium. Chip supplies are no longer a major challenge within the industry, and despite recent concerns regarding floods, we anticipate a consistent distribution of monsoons that will bolster the agricultural sector, consequently benefiting the automotive industry. The passenger and commercial vehicle segments continue to bolster the promising outlook for future growth. Notably, India's passenger vehicle sales exhibited a significant 9% increase during Q1 FY2024 as reported by SIAM, when compared to the corresponding period of the previous year. This surge in passenger vehicle sales is largely attributed to the strong demand for SUVs. The prospects for the passenger vehicle sector remain highly favorable, as seen by the trend of new car orders facing a waiting period of exceeding 6 months and increased inquiries across models. Two-wheeler sales witnessed an 11% expansion during Q1 FY2024, driven by the resurgence of the rural economy. Within the two-wheeler segment, the consumer inclination is progressively shifting towards higher CC models as opposed to the entry-level variants. After a prolonged period of demand stagnation, this segment is now showing signs of revival. The EV revolution is in full swing, and India is swiftly positioning itself as a formidable global manufacturing hub for electric mobility. On the EV front, the recent adjustment in FAME subsidy structure promptly influenced consumer actions, resulting in an upswing in purchasing in May 2023. We anticipate a continued rise in demand, the evolving consumer mindset toward renewable alternatives, and contribution towards this momentum. During the quarter, we have made the following new launches in the passenger vehicle segment: gear shifter systems for Maruti Suzuki's Jimny and Fronx models. With continuous new launches by the OEMs, we have also been able to garner new businesses. Our content per vehicle has been increasing owing to our presence across multiple product categories and long-standing relationships with all major OEMs in India. On the financial front, our consolidated revenues grew by 50% on a year-on-year basis and stood at rupees 632 crores. Our EBITDA stood at rupees 88 crores, up by 82% on a year-on-year with an EBITDA margin of 14%. The standalone entity caters to integrated plastic modules, aftermarket business, seat structure, chassis and swing arm for two-wheelers, trailing arm for three-wheelers under the metallic business and two-wheeler lighting. The standalone entity has contributed 47% of the total consolidated revenues for Q1 FY24. IAC India, the recently acquired 75% subsidiary, which is a Tier 1 interior system supplier to key automotive OEMs in the country, including Mahindra, Maruti Suzuki, Volkswagen, and Volvo Eicher commercial vehicles, among others, has contributed 32% of the total consolidated revenues for Q1 FY24. The IAC management team, along with Lumax, will certainly continue to drive the business growth forward. The board of directors of IAC India has approved the scheme of merger with its holding company live on August 4, 2023. Lumax Mano Alloy Technologies, the 55% subsidiary which manufactures manual, AMT and automatic gear shifter systems and has a market leadership position, contributed 12% to the total consolidated revenues. The company received awards in two categories, namely inner parts localization and value analysis at Maruti Suzuki Vendor Conference held in May 2023. Lumax Cornaglia Auto Technologies, the 50% subsidiary manufacturing air intake systems and urea tanks, commanding 100% share of business with Volkswagen and Tata Motors, contributed 6% to the total consolidated revenues. This joint venture holds a strong order book, and we are optimistic for its performance for the remaining period of the financial year 24. The company's new facility is expected to commence from Q3 with the addition of plastic fuel tanks as a product. Lumax Ituran Telematics has successfully commenced supply of telematic parts to Daimler India in the current quarter. The volumes are expected to grow significantly in the remaining part of the financial year with addition of certain new range products. I'm happy to share with you that your company is sitting on a healthy order book of around 1,000 crore rupees. 95% of it is new business, and out of which approximately 90% is in the JVs and subsidiaries. Now I would like to hand it over to Mr. Sanjay Mehta, Director and Group CFO, to update you on the operational and financial performance of the company.
Good afternoon, everyone. I will brief on the operational and financial performance for Q1 24. For Q1 24, integrated plastic module post IAC business contributed 47% of overall revenue, followed by aftermarket at 13%, gear shifter at 13%, fabrication at 8%, emission at 6%, lighting product at 5%, and others at 7%. For the first time, share of passenger vehicle has overtaken two and three-wheelers with PVs at 45%, two and three-wheelers at 24% to overall revenue, aftermarket at 13%, CVs at 9% and others at 8% for Q1 FY24. For more detailed operational highlights, one can refer our investor presentation uploaded on the exchanges and company's website. With respect to financial highlights, the consolidated revenue stood at rupees 632 crores for Q1 FY24 as against rupees 422 crores last year, up by 50%. Revenues for IAC India stood at rupees 201 crore and EBITDA stood at rupees 37 crores. EBITDA margin stands at 14% for Q1 as against 11.5% for Q1 24, up by 250 basis points. Absolute EBITDA for Q1 24 stood at 88 crores, a growth of 82% on year-on-year basis. PAT after minority interest for the quarter stood at 22.1 crores as compared to 21.8 crores in Q1 24. PAT margins stood at 3.5% for Q1. The lower PAT with respect to last quarter is because of higher interest cost on account of long-term debt of rupees 400 crores and high depreciation of intangible assets on account of acquisition of IAC India. The net debt as of Q1 FY24 is rupees 100 crores. The capex incurred during Q1 is rupees 8 crores. With this, we open the floor for questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Abhishek from Dolat Capital. Please go ahead.
Good afternoon, sir, and congratulations for a strong set of numbers in tough time. Sir, in this quarter, there is a sharp jump in depreciation expenses due to consolidation of the IAC. But jump in depreciation is higher than the expected. So just wanted to know that is there any one-offs and what would be the run rate in the coming quarter for the depreciation?
There is no one-off in that because the consolidation of IAC and we have to recast consolidated figures on the, as per accounting standard, on the purchase price allocation. So intangible assets has been created almost around 334 crores. Out of that, 213 is where the depreciation is there from 5 to 15 years on account of non-compete, customer relationship, etc. That is the reason the depreciation is higher on consolidation.
So how much gross block addition has done because of the IAC India?
So the total gross block is 602 crores including intangible of 334 crores.
Okay. So because of the intangible assets, there's a higher depreciation there. That's why the depreciation number is looking high.
Yes, because what happens, this particular merger scheme as a tax-efficient mechanism, we have provided that intangible assets so that way forward we have the cash benefit through tax, lesser tax, almost 6 crores post-merger of IAC with the line.
But in this quarter also the tax was higher. So did not we get some benefit because of this?
No, the tax will be benefited when the merger will happen. So it is simply right now the consolidation and way forward I think within a year's time we are hopeful that merger will take place. So this benefit will be available retrospectively from this financial year. Okay, sir.
And in plastic integrated part, how much is revenue from the this IAC India and how much is from this Lumax Auto Technology?
So the integrated plastic is about 300 crores for the quarter, out of which roughly about 200 crores would come from IAC.
Okay. And sir, in this quarter in lighting business segment, we have seen degrowth, and this is despite the quarter-on-quarter recovery in the volume of Bajaj Auto. So what is the reason of this fall in the lighting business revenue?
The lighting business revenue is again largely driven by certain Bajaj Auto models. If you look at Bajaj Auto's export portfolio on a quarter-on-quarter basis, it has actually degrown by approximately 35%. So when you look at Bajaj overall, you don't see that impact, but within Bajaj Auto, the export models have taken a beating, and since we are also largely catering on the export models, so that's one of the reasons why you see a 20% decline or 28% decline in the lighting on a quarter-on-quarter basis.
But we have not seen this sort of the impact in the previous quarter, because that Bajaj export is down from last many quarters. But this quarter we have seen a very significant decline. Is there any model mix because of that it happened?
No, so it's basically a mix of the domestic and the export. The domestic business is also just under pressure for Bajaj. So it's just a overall product mix. I mean, export is down, but then certain models which we cater to on the domestic have also not seen a top-line growth. Rather, it has also declined on a quarter-on-quarter basis year-on-year. So there is nothing untoward, but we do expect that in the subsequent quarters there will be recovery on the Bajaj Auto volumes per se.
Okay, sir. And my last question is aftermarket business. We have seen a significant decline in this quarter. So just wanted to understand what is the reason and what would be the run rate going ahead in aftermarket business.
I think you're seeing a decline if you're comparing with Q4. But if you look at from a Q1 to Q1 perspective, there is almost flat or a negligible 3% growth. But traditionally, aftermarket in the Q1, because the full year contracts, etc., are still signed and commitments are taken from the channel partners. So Q1 is probably the lowest. And if you see that trend historically, it remains intact. For the full year, I think we are still bullish. We are still looking at good, maybe upwards of 18 to 25% growth for the aftermarket for the current year, for the full year.
Okay, sir. Thanks, sir. That's all from my side.
Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Harshul Shah from AM Investments. Please go ahead.
Am I audible?
Mr. Shah, please use the handset.
Hello.
Yes, please go ahead.
I have a couple of questions, sir. And firstly, congratulations on great set of numbers. So my first question is on each of the subsidiaries. Can you elaborate the timeline as in when will each of the subsidiaries start contributing?
Is there a specific subsidiary or a joint venture? Because, for example, a Mano and a Cornaglia are already contributing. And,
correct. So I would like to say, like in FY23, around 4 subsidiaries were loss-making. One sec. So Lumax FAE, Lumax YOP, Lumax Yokowo, Lumax Alps, and Lumax Uturan. So these 5 subsidiaries which are not contributing as of now and can contribute. Can you just give us when can they be meaningful, give meaningful contribution, like 20-30 crores kind of thing?
So I'll let Vikas take this first, and then maybe I'll supplement wherever required.
All right. So, Harshilji, I will elaborate on the subsidiaries and the joint venture. So, Lumax Mano, as you are aware, already is well established and very profitable subsidiary for us. Lumax Cornaglia also is a profitable subsidiary for us and is showing significant revenue growth. Lumax Alps has been a joint venture which has been formed in December 2021 only. And this is still an incubation period in terms of the order book generation, where we have seen a very healthy order book generation. And in terms of the product life cycle of the OEMs, the first major revenue contribution will start coming from FY25. However, they are technically not losing any money right now. They are just about breaking even. Then we come to Lumax YOP. Lumax YOP has gained significant orders for the first time from major OEMs this time in Q1. And again, we are expecting the Q1 of FY25 to be a high profit earner for this joint venture when those products start getting established. Lumax Yokowo this year will turn profitable by Q4 because it has already gone into SOP. Also, Lumax Uturan will turn profitable as early as probably Q3 only. because it is going into the SOP in next 1 to 2 months from now. So this pretty much says everything except Lumax FAE, because Lumax FAE continues to be impacted highly by the government regulations. We have seen 2 deferments of OBD2 deadlines. We are still not very sure if the OBD2 norms will be implemented even in April 25 as per the last Gazette, seeing the surge in EVs. So about FAE, we would like to reserve our comments right now, and we'll be able to give a better picture maybe in another 1 or 2 months from now.
Okay, sir. Okay, and sir, can you? And this question is from Mr. Anmol. Sir, can you give us now the growth? Where will the incremental growth come from? If we want to go from 2,800, 2,900 crores this year to 4,000 crores in a couple of years or 2 to 3 years, so where will this incremental growth come from? ISE is done, and this 1,200, 1,400 crores of top line, where will it come from, sir?
So I would like to say that I think let's look at the bucket in 3. One is ISE, one is aftermarket, and let's say one of the rest of the business, which was, the legacy business or multiple joint ventures. I think all 3 will contribute. Aftermarket, we are still very bullish. Aftermarket continues to grow at, let's say, give or take, as I mentioned, 18 to 25% on a year-on-year basis. So that will continue to grow at maybe at least a 15% even going forward in the next 2 to 3 years. ISE by itself will also have a significant growth. We are trying to also grow the account of Maruti Suzuki, and we've got some very deep engagements already. So we are hoping that maybe in the next 2 years, the footprint in Maruti Suzuki should expand for ISE. But until then, I think we have a very strong order book at ISE for all the EV platforms of Mahindra as well. So that by itself should give a significant incremental revenue to the entire consolidated revenues. Coming to the third bucket, which is the, let's say the legacy joint ventures, I think I'm very optimistic on specifically 2 joint ventures. One is the Lumax Alpine. There is a good order book and not just dependent on the domestic OEM volumes. We are also very deeply in talks with the partner to try and make India a global manufacturing hub for some of their products. These are, some old technology products from Japan's standpoint, and we may actually relook at India becoming a massive hub. So that would not be dependent on the domestic OEM production numbers, but it will be like a global export business out of India. So that's something which we are currently working upon. And the other joint venture, again, Mano and Cornaglia will continue to have a, decent growth based on penetration of new customers on Cornaglia and technological changes in Mano. But the second is the Lumax Yoke. I think Lumax Yoke has already got some good order book from one of the key customers, Maruti Suzuki. And I think going forward, now we are strategically aligned with Maruti's overall expansion plan, and that would be one joint venture where we see a good incremental revenue coming over the next 2 to 3 years.
Okay, sir. And one last question from my end. Sir, are you seeing the Mahindra is planning to ramp up their production? So are you seeing that in their inquiries, sir?
Absolutely. I think Mahindra is every day trying to ramp it up, and specifically on 2 models, on their Scorpio and the XUV 700, where there is a very high waiting period and a high demand. But again, we are ready, but, as I said, the vehicle cannot be made unless until the entire supply chain is ready. So there is a constant pressure, and I think it will still take some time for Mahindra to attain the levels they're talking about, but I'm sure that they will get there.
Thank you. Thank you to the entire management. Thank you for answering all the questions. That's it. Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of A.M. Lodha from Sanmati Consultants. Please go ahead.
Hello. Good morning, sir. Am I audible, sir? Good afternoon. Hello.
Yes, you're audible. Please go ahead.
Sir. Sir, actually, if I look at the standalone results, there is degrowth in your sales and as well as the profit has been held to 50%. can you specify the reason of the such a degrowth in the June to year-on-year June to June 23?
So, if you take out IAC, the year-on-year revenue is just flat. It's a 2% negligible growth from about 422 odd crores to...
I'm talking of standalone first, sir. Then I will come to the consolidated.
Is talking about what, sir?
Standalone, sir. Standalone.
So, on a standalone basis...
there's substantial fall in the profit. The profit was... before tax, it was 25 crore, not 15 crore only.
So this is largely because of one customer, which is Bajaj Auto. There are two specific businesses which operate in the standalone entity, which contribute majority of it from an OEM perspective, apart from aftermarket. One is the lighting, and the second one is the chassis business. Now, Bajaj Auto, as I mentioned, has taken a huge beating in their quarter-on-quarter volumes, specifically with respect to the export segment. And that is one of the key reasons why we have seen a decline in Bajaj Auto. Secondly, the HMSI also we have dipped on the revenue of the plastics business, primarily because there have been certain part deletions from some of the models. And that's got a loss of revenue specifically on the plastic business. And the third is the aftermarket. If you see on a year-on-year basis for quarter one, the aftermarket business is pretty flat. So there is a degrowth in the Bajaj and HMSI business, and aftermarket is pretty flat. These three put together contribute almost close to 80% or 75% of the standalone revenues. So this is primarily the reason why you don't see, or you see a gap in the standalone on a year-on-year basis.
Can we expect growth in coming quarters in the standalone basis, sir?
Yes, I think largely it would be driven by aftermarket, because aftermarket, as I mentioned earlier, is likely to grow between 18 to 25%, and really it depends on the Bajaj Auto volumes. I am hopeful that from quarter 3 onwards, Bajaj Auto should be back on track in terms of volumes. They've still been struggling in terms of the domestic and the export. But I think for the full year, I would be safely saying that there should be a double-digit growth for the standalone business overall. So I do look at maybe a 10% plus growth for the full year on the standalone.
Sir, now I am coming to the consolidation. I attended the conference call, the last Concall. I attended the last Concall. And the management has projected 25 to 30% growth on basis of the standalone as well as subsidiary. That means 1,800 crore turnover we achieved last year, and management was projecting 25% growth in the standalone and as well as subsidiary. In addition to the numbers of the IAC, which is approximately 750 to 800 crore. Now you tell us, sir, what in this current year, what turnover which company can expect to end the year FY24 and FY25?
So FY24, there are, again, for example, there has been a delay in the oxygen sensors based on regulation. So that is one of the reasons which we had forecasted revenues in FY24, but that again gets moved forward. So that's one of the reasons why there will be a dip in the projected revenues from earlier. But my still guidance for FY24 would still be close to around 12 to 15% top line growth of the consolidated entity without the IAC revenue. In FY25, if I look at my order book without IAC, almost close to 65% to 70% of my order book will come into the revenue in FY25. So for FY25, this growth I would anticipate would be much higher. It would be probably around the 20 to 25% band.
In FY25?
In FY25.
But FY24, I remember very well, sir. I attended the Concall. I remember very well that the management projected at least 25 to 30% growth in standalone as well as the consolidated basis, along with the subsidiary, apart from the IAC. Now you are saying that it is not 12%. It is substantially down from the 25 to 30% to 12%, 12 to 13%.
Well, I think maybe there is some misunderstanding. I will have to check the transcript of the earlier calls, but I think we probably gave a guidance of around 15% to 20% for the without IAC growth. However, this again is slightly downward, as I said, to 12 to 15% based on market dynamics.
12 to 15% means comes to some 1,800 crore. Last year we have achieved the turnover without IAC. It comes to 250 crore rupees approximately. Approximately 250 crore, it means 2,000 crore around. Plus IAC 800 crore. Can we achieve 2,800 crore in current year, sir?
That is the outlook for the year, that yes, we should be looking at a similar number between maybe 2,700 crores to 2,900 crores is what the estimated number is with IAC this year.
And then next year we can expect 30% growth in the turnover.
Well,
in FY25.
Let me clarify. You are seeing 30% growth. I would not say 30% growth on 27, 28, 2,900 crores. Please understand, IAC is largely a single customer-driven business. You cannot anticipate a 30% growth. If you tell me,
I am not talking of 30% growth in IAC. I am not talking of 30% growth in IAC, sir. I am taking IAC at 800 crore only. I am not taking 30% growth in. I just wanted once you reach 2,800 crore to 2,700 crore in the FY24, how much turnover we can expect in FY25?
So in FY25, based on the guidance I've given you, out of 2,800, let's say if you take out 800 of IAC, the other business is 2,000 crores. On that, if you to take a 20 to 25% growth, that by itself comes to around 500 crores, and then you add back around 800 crores with some organic growth of 10 to 12%, 900 crores. So there, if you do the math, that number works out to be close to around 3,500 crores, give or take.
Okay. Thank you very much, sir. Thank you very much for clarification. What about margin, sir?
Well, our endeavor is always to get into teen margins. Again, we've reported 14% for the quarter. This is largely driven by IAC, but even without IAC, there is a slight margin expansion of 0.3% quarter-on-quarter, year-on-year basis on the non-IAC business. And I think we do expect the margins to remain intact or slightly further grow for the full year basis with IAC.
Thank you very much. Thank you. I will rejoin the queue if anything there.
Thank you.
Thank you. We have the next question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for opportunity again. Sir, in case of the depreciation, what would be the run rate from FY25 when the impact of this intangible asset would be gone away? So what would be the run rate?
No, intangible assets as per group, that impact will be because it is from 5 to 15 years, so that would be there. 30 crores per quarter for this year.
And what kind of the benefit will get in the in terms of the tax?
Get affected because we will claim the depreciation in the income tax act, so that tax benefit that would be in the origin of 6 to 7 years will be around 53 to 60 crore rupees.
Okay. And on annual basis, what would be the benefit?
Annual basis will be around 6 to 8 crore rupees per annum. In the cash outflow, the less tax payment need to be paid. Okay.
And sir, in this quarter, if I talk about the margin of IAC India, that is very much strong of around 18%. So it includes other income as well?
Yes, it includes other income.
And excluding other income, what is the margin, and what will this margin will be sustainable in the coming quarter?
Excluding other income, it will be closer to 16%, and that will continue in the range of around 15 to 16% throughout the year, excluding other income. And including other income, it will be closer to around 17 to 17.5%.
Okay. And sir, you are talking about the new business from the Maruti in IAC India. So what is the potential of that business? And second, what is the current customer base in IAC India?
So there is definitely a lot of potential. I would like to clarify that Maruti Suzuki is already a customer of IAC India. And if you look at the customer mix, I think almost close to 130 crores of business is of IAC to Maruti for the quarter. For Mahindra. But Maruti is about 15 crores or so for the quarter. So my take is Maruti definitely will expand in the coming years, but it will take some time because there is going to be obviously a lot of policy changes probably to be done at Suzuki Japan level as well, based on a cockpit manufacturing. Right now, Maruti is not in a complete cockpit manufacturing to a tier 1. So, but the engagement is already on. We also did a tech show at Maruti Suzuki, which was very, very highly appreciated and accepted. So that engagement has already started. Apart from that, your second question was, who are the key customers of IAC India? Is that correct?
Yes, sir.
So about 70% of the customer base is Mahindra and Mahindra. About close to 10% would be Maruti Suzuki. Close to around 5% each would be Volkswagen and Volvo Eicher, and then we have about certain 3 to 5% of some export business to IAC group companies as well.
So, how much growth you are looking from your existing customer? I mean to say that Mahindra is a major customer, and there is a strong growth there because they are adding the capacity. So, what kind of the growth you are looking for? From the Mahindra and Mahindra perspective?
So if you look at Mahindra and Mahindra, I think Mahindra and Mahindra has anyways for the consolidated entity become the number one customer. We've done almost 160 crores of revenue from Mahindra in the first quarter, out of which 130 odd crores is IAC. And Mahindra, even without IAC, has gone from 19 crores in quarter 1 of last year to almost close to 30 crores or 28 crores in the current quarter. So I think we are very bullish on Mahindra. Multiple other joint ventures of ours, be it Lumax Manno, be it Lumax York, are all pretty deeply engaged and entrenched into Mahindra already, where we have a current supplier relationship, and we will further grow and expand onto that in the coming quarters, in the coming years for sure. And Lumax Cornaglia also has recently started engagement with Mahindra and Mahindra, and we are hopeful to get into SOP for some orders probably in the subsequent quarters.
So, what is your current capacity in the IAC India, and do you need any capacity expansion because of the new business from the Maruti?
So yes, there will be some capacity enhancements as a brownfield expansion in IAC India, but again, not for Maruti. It would be mainly for Mahindra. As I mentioned, we are sitting on a very strong order book of Mahindra and Mahindra for their EV models also. So the capacity expansion would be for both enhancement of the volume of the current models, including the forthcoming models, and also the new platforms of the BEV electric vehicles, which will start rolling out from FY25 onwards.
So what kind of the capex you are looking for the FY24-25, both in the standalone and in IAC India?
For FY24, I can give you guidance. FY25 is too far-fetched to give you guidance, but I think for FY24, we are looking at around 140 to 150 crores capex in totality, which IAC India by itself, out of which would be around 55 crores, and the rest of the business would be roughly around 80 to 90 crores.
Okay, sir. And my last question is on this order book. You mentioned around 10 billion order books. So how much order is from the IAC India out of 10 billion?
So out of roughly 1,000 crores order book, or more precise, it's around 950 or 960 crores order book. Roughly around 650 crores is IAC, and roughly around 350 to 375 crores is the non-IAC part.
So as the most of the order books are coming from the IAC India and margin of IAC India is very much strong. So can we expect a margin of 13-14% in the coming year because of the change in the mix?
So, well, as I mentioned, I've already said this. In Q1, we've reported a 14% EBITDA margin consolidated. For the full year, my guidance remains the same. And I think my first endeavor before getting into IAC, if you recall, I had always said our endeavor is to get into the teen EBITDA. So I'm happy that at least for the quarter and for the full year estimation, we are looking at a teen EBITDA of maybe around 14% or upwards. So yes, it should continue to sustain, and we will always, our endeavor would be to further expand the margins in the coming years.
Thanks, sir. That's all from my side.
Thank you.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Prachi Sharma from Ace Capital. Please go ahead.
Hi, sir. I just have a couple of questions. So on the performance front, our performance this quarter, excluding the IAC India, has been relatively flat. So I just wanted to know, as like against the industry and the peers, I just wanted to know where did we fall short this quarter?
Ma'am, I'm not sure if you just joined the call because I already explained this a few minutes ago, but just for your benefit, I think there are 3 fundamental reasons why you look at quarter 1 revenues being flat without IAC. One, as I mentioned, there has been a degrowth in Bajaj Auto by almost close to 15 odd crores. And that primarily is because a hit on certain models of the domestic market for the lighting and export, and a lot of significant hit on the export models for the chassis business. If you look in the overall production of Bajaj Auto, their export model production is down by almost 35% on a year-on-year basis. So that's reason number 1. Reason number 2 is that aftermarket, obviously, has had a flat growth on a quarter-on-quarter basis, and that is largely because quarter 1 historically is usually a lull quarter, and the pace picks up in quarter 2 and quarter 3 onwards. So we do expect for the full year, the growth estimate of aftermarket still between 18 to 25%. And the third reason is on HMSI, we have had almost a 10 to 15% degrowth, and that largely is nothing to do with a wallet share or a reduction of share of business, but certain parts have been deleted in some models. And that's the reason why I would say that these 3 factors largely put together have had a flattish growth. But, flattish revenue on a year-on-year basis. But as I mentioned earlier, for the full year, without IAC, we are still expecting anywhere between a 10 to 15% growth on the business of, other businesses, let's say, without IAC.
Understood, sir. I'm so sorry for missing this point earlier. I'll just get back in the queue in case of any other questions. Thank you.
Thank you very much. Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of A.M. Lodha from Sanmati Consultants. Please go ahead.
Thank you very much, sir, for follow-up question. Just I wanted to know the gross debt of the company is on 30th June and the net debt of the company.
The growth is, I believe, 22% as on 30th June.
Meaning debt loan taken by the company.
Long-term debt is 409 gross long-term debt, and the net debt is 100 crore. It means we are having the cash and bank balance of 300 crore.
That is after the money utilized for the payment of the acquisition of IAC.
Yes.
So it means can we after spending the 150 crore on capex, can we presume that the company will be net debt free by March 24th?
We will try, but we are not sure at the time because after capex and lot of programs are there. But yes, definitely the debt will be decreased way forward.
Okay, thank you. Thank you very much, sir. Thanks a lot.
Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Nagaraj Chandrasekhar from Emerge Capital. Please go ahead.
Hi, thanks for taking my question. What is the long-term plan on the remaining 25% at IAC, and any agreement we have to make that a 100% subsidiary and then merge it with the standalone entity, and what would be the outgo for that?
So as of now, there is no such talks. I think for 5 years, there is a clear understanding that the partner IAC will continue to remain intact and invested in the Indian market. And please understand, I think, the reason for them to sell out to a Indian local partner was not that they are not bullish or confident about the prospects of the Indian industry or the Indian market. The reason was fairly simple. IAC came in for their key global customers like the Ford and General Motors, and unfortunately both of them have packed up and left. They did manage to crack Mahindra and Mahindra over the years, and obviously now they are a significant player within Mahindra and Mahindra, which continues to grow. So I think their interest remains in the Indian market, but to expand the footprint of IAC India to other customers and grow it further, they needed a local partner which has deep entrenched relationships. So they were happy to continue supporting India as a market through technology and innovation, but they definitely didn't want to be in the driver's seat because they don't have that prominence and presence across the other OEMs. So that's the reason for their shift. But answering to your question, as of now, there is no plans to make it 100%. I think we see significant value add coming from IAC Global, and for now, we will continue to manage it as two partners.
Understood. And the margins there this quarter have really expanded to close to 20%. Would there be, now that you own 75% of this and are focused on winning as many customers as possible, driving that yourself, one is, can those margins sustain? And two, would there be some sort of royalty that would be charged by IAC for their technological know-how, transfer of these from their global entities to you?
So number one, the margins, we anticipate them to actually be sustainable, maybe a percent here or there. I mean, instead of 18.5%, which is reported, maybe around 17% is what I reckon would be a more sustainable one. Coming to the second part of the question, there is no royalty payments to be done, and please do understand that there is almost 200 engineers which work out of the engineering center in Pune and have the end-to-end capabilities of designing, engineering, doing a product development along with validation for the customers. So we are not really dependent on IAC Global with respect to development and designing, but yes, there are cutting-edge technologies which usually flow in from the high-end luxury segment into the most mass market segment, especially in interiors. When you look at the luxury vehicles, you will see a very different class of interiors than the mass market. So I think that is the innovation and, let's say, the future of interiors where the value add comes from IAC Global. But with respect to designing and developing for the local market needs, the engineering center in Pune with 200 plus engineers is self-reliant and self-sufficient.
Understood. One final question on the pushing back of the oxygen sensor business to not being there for the foreseeable future. What sort of delta to your expectation of that 25% plus growth ex-IAC in FY24 is just purely due to that, and that being pushed to 25, maybe beyond?
Well, let Vikas speak specifically on the oxygen sensor, and then maybe I will come back in for the overall growth numbers.
So, Mr. Nagaraj, the oxygen sensor joint venture continues to be a question that we are internally deliberating, largely because being a regulation-driven product. While this year FY24 was supposed to be the ramp-up year, going to probably April 25 when the OBD2 regime was to be announced. But unfortunately, again, the OEMs have taken a review call on oxygen sensor, and what was expected to be two heated oxygen sensors per vehicle. A lot of OEMs are internally right now deliberating if it should be one heated sensor and one unheated sensor. Lumax FAE manufactures the high-end technology-intensive heated oxygen sensor and does not manufacture unheated sensor. To this effect, we have moderated our order book right now. If you see the current order book that we are indicating without ISC to be about 334 crores, actually, if we took the last quarter's example, we should have been saying 450 crores, but 120 crores currently in terms of the order book for oxygen sensors, we have put into hibernation. Because this is something that the OEMs have to answer and they have to clarify. This will take at least another 1 or 2 quarters before the entire situation clearly emerges, being a regulation-driven product, and this is not something which can get into a replacement market.
So given that, I think, as I mentioned earlier, we're still envisaging for the current year FY24 anywhere between a 10 to 15% growth on the non-IIC part of the business, which you see flat in the quarter one. And for FY25, depending on certain organic volume growth as well as the new order books, we're looking at maybe around 20 to 25% growth without the IAC piece for FY25.
Understood. Thank you.
Thank you.
Thank you. We have the next question from the line of Neeraj from an investor. Please go ahead.
Yeah, hello. Can you hear me?
Yes, please go ahead.
Yeah, thank you for the opportunity. I have just 2 sets of questions for the management. One on the margin front. So before our ISC acquisition, even before that, we used to target like a teen kind of a margin. So if I remove ISC and from our base business, do you still expect like 13-14 business margin, excluding ISC, please?
Yes, absolutely. The guidance remains intact. We had been hovering around a 12% EBITDA margin without ISC, which continues to be reported at 11.8% for the quarter for reasons which I explained earlier. And we're very clearly in the vicinity of attaining a 13% or so EBITDA margin without ISC for the entire year. The guidance remains intact.
That's great. Thank you. And second question, I read a couple of articles just after our ISC acquisition. The management over there mentioned because of the new regulation around, the AC regulation in the cockpit, and, it can provide incremental growth opportunities on the ISC side. So can you please elaborate a bit more on this, like what opportunities can shape up in the coming years because of this regulation?
So the regulation we're talking to is about what? I didn't get you.
Around the mandatory AC in the truck cockpits, right? And we mentioned in some of the articles, like, ISC has some offerings in this segment. This is what I understood from some of your interviews after the acquisition.
Correct. So as the cabins of commercial vehicles get regulated, there would be more and more changes in the, let's say, ambient temperature as well as the materials used for the interiors. So currently, for example, Volvo Eicher vehicles is already a customer, but the kind of materials we are using would be, let's say, very different than that what are going into a passenger car space, and hence the content per vehicle is very, very different, driven largely by price and, maybe compromising on the look and feel in totality or the comfort for the driver. I think as the cabin becomes more plush and maybe driven, and air conditioning and all, we expect more premium materials or premium look and feel to also take center stage, and hence the content per vehicle should also go up. That's what I meant in terms of the opportunity for ISC with this regulation on commercial vehicles.
Understood, sir. Thank you so much. All the best.
Thank you.
Thank you. We have the next question from the line of Harshil Shah from AM Investments. Please go ahead.
Hello. My question, net debt stands at 100 crores and we will do around 350-400 crores of EBITDA annually. So my question is, are we looking at any other acquisition in organic growth and which segment of the market?
So currently, we do not have any plans to look at any other acquisition. However, as I mentioned, the company continues to remain engaged with certain opportunities, both organic and inorganic space, and we're always open to exploring opportunities where, the organization can grow forward on its core competencies. So I think right now there are no such plans, but as and when there is something concrete, we'll be happy to share with you.
Okay, sir. Thank you.
Thank you.
Thank you. We have the next question from the line of Puneet, an individual investor. Please go ahead.
Thank you. Good afternoon, Mr. Anmol Jain.
I'm sorry to interrupt, participant. Sir, you're not audible. Please, could you increase the audio from your end?
Sure.
Or switch to handset.
Any better now? Is it any better now?
So it's still the same.
Is it better now?
Yes, please go ahead.
Good afternoon, and this is accountant for individual long-term,
sorry to
investors.
interrupt, Puneet, but your audio is fluctuating again. Could you please come back in the queue?
Hello? Any better?
Yes, go ahead.
Is it any better?
Yes, go ahead, Puneet.
Okay, sorry. So, Mr. Jain, my specific question is I'm a chartered accountant and an investor in your stock for almost more than 15 years now. And I have just one small observation. And my specific question is on the volatility of the, stock, right? And although I'm not overwhelmed or I'm not disturbed, but my observation is that, sometimes during the intraday, it gets a lot of, spikes, 10% up or 10% down. And that's happened just about, 4 or 5 days ago. So anything that we as management can do to stabilize such kind of volatility?
I can only say that, thank you for your faith and confidence for being a long invested shareholder of the company. In terms of the second question, I really don't have an answer. I don't follow the stock market. The management is the same. The strategy and the long-term plans remain the same. So we actually spend a lot of time in running the business. You are the guys who run the stock market. So I actually have no idea why the volatility, why it goes up or going down. But happy to hear your views on a separate platform if you have any. But I have absolutely zero input there.
I respect your comments. Thank you. And, I have full faith in the management and also the performance of the company. And therefore, I stay with confidence that I stay for all these years. Thanks.
Thank you.
Thank you. We have the next question from the line of Apurva Mehta from AM Investments. Please go ahead.
Hello.
Yes, please go ahead.
Yeah. Congratulations on a great set of numbers. Just wanted to know our long-term plans on the EV, participating on the EV side, on the EV parts, especially on any long-term plans on looking at EV parts?
Well, absolutely. I would say that out of the roughly 960 crores order book, almost close to 1/3 of it will be on EV. So, there's a large EV play which IAC has for the complete entire interior systems for the forthcoming BEV platforms of Mahindra & Mahindra. So almost, as I said, 1/3 of the order book is going towards the EV models in the future.
No, not exactly the EV models. I want to go across that any EV parts, specific EV parts, related parts, which are electric parts or electric components or on the battery side or on the different components which are there.
So, Purvaji, we've debated internally a lot, and frankly, the way EV is going, I think number one, from a passenger car space point of view, I think at best, the estimates say that anywhere between 10 to 12% would be the EV penetration, even up to 2030. Two-wheelers will obviously have a higher penetration, but that is a very low value add proposition where there are very few parts and very many players. It's already kind of gotten too crowded and commoditized. Plus, the legacy players would continue to drive this, according to me, rather than the new entrants. There are already a lot of issues with respect to the FAME and, you know that better, on the EV part. So for us, what we are rather exploring is how do we get into certain alternative energies, alternative fuel, let's say, product lines instead of getting into specific EV critical components. So we are still on the evaluation stage, but I think the more we are evaluating, we are getting that sense of confidence that rather than going into EV specific, we would probably go into certain other adjacent alternative fuels or alternative energy product lines.
Okay. And on the export potential, where we were talking a lot of things about your JVs turning into export. For example, Manu is there, or maybe Turan is there, or maybe any other JVs which you think can be a big potential for. Can you throw some light on that side of business?
I think the only joint venture which we are very bullish about export is the Lumax Alps Alpine. The rest of the joint ventures do have some export opportunity. Lumax Mano already does some export directly into Indonesia and other markets through the OEMs domestically. But I think the big one there is the Lumax Alps Alpine. As I mentioned, what we're trying to make Lumax Alps Alpine is, because of cost competencies, make India as a global manufacturing hub for Lumax Alps Alpine products, especially those products which either are, old technology for the Western markets, but they are very relevant still in India. So we'll probably shift the manufacturing base globally for Alps Alpine into India, start exporting back to Alps globally, and then also penetrate into the OEMs because once we have the manufacturing capabilities and capacities of those products, it's very easy for us to open doors into OEMs for the same product and the same technologies. So that's probably the only joint venture where we are talking about big numbers for exports.
Okay, thanks, and wish you all the best. Yeah.
Thank you. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question, and we would now close the question queue. I would like to hand the conference back to the management for closing comments. Please go ahead.
Well, I take this opportunity to thank everyone for joining into the call. We will keep updating the investor community on a regular basis for updates on your company. I hope we have been able to address all your queries. For any further information, please get in touch with us or Strategic Growth Advisors, our investor relations advisors. Thank you once again and have a good day.
Thank you, members of the management. Ladies and gentlemen, on behalf of Lumax Auto Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.